Let me tell you a story, and I bet it's going to sound painfully familiar. So, you decided to do the responsible thing, right? You started a systematic investment plan, a SIP. You did your homework, picked a good fund. You basically did everything by the book. And you were disciplined. Same amount of money every single month, like clockwork, no missed payments. You weren't trying to be a genius, timing the market. You were the perfect model investor. And then it happened. The market took a nosedive. You open up your app and all you see is that sea of red. Suddenly, all that discipline, all that patience, it starts to feel like a huge mistake. You're looking at the numbers and that little voice in your head starts talking. Wait a second. I've been putting money in for how long? And I've made what? Practically nothing? And that's when you do it. You quit. You stop the SIP. Maybe you even cashed out. And here's the kicker. The part that really, really stings. Just 6 months later, boom, the market recovers. All your friends' portfolios are green again, and you're just sitting on the sidelines knowing you sold at the absolute worst time. Look, if that story felt a little too real, it's because it's probably the most common story in all of investing. And it points to a truth that a lot of us miss. We love to blame the fund or blame the market, but the real problem is this. SIPs don't fail. Investors quit. Okay, get ready for this number because it's kind of shocking. On average, investors earn about 3.5% less than the funds they're actually invested in every single year. Let that sink in. The fund is doing its job, but the person investing in it gets a worse result. Why? It's not about the fund. It's about our own behavior. It's about pulling the plug at the worst possible moment. All right, let's make this super clear. Imagine two people, investor A and investor B. They both invest 500 rupees a month for 20 years in the exact same fund. The only difference, investor A just keeps going no matter what. Investor B, well, they get scared during the dips and hit the pause button. So what happens? This right here is the real cost of fear. After those 20 years, investor A, our study one, has 380,000 rupees. But investor B, the one who panicked, only 250,000. That is a massive 130,000 rupee gap. And it has nothing to do with the fund and everything to do with psychology. So the big question is, why? Why do so many of us, smart people, make this exact same mistake over and over again? Well, it's because our brains just aren't built for the slow, steady grind of SIP investing. We're wired to fall for these 3 hidden psychological traps. So let's break them down. First up, losing money just hurts way, way more than making money feels good. Second, our brains think that if something is boring, it must be wrong. And third, we have this totally warped idea of what early returns are supposed to look like. This first trap has a name: loss aversion. Basically, the pain of losing, say, 1,000 rupees, is about twice as powerful as the good feeling you get from gaining 1,000. So when your portfolio turns red, your brain isn't thinking, oh, what a great long-term buying opportunity. No way. It's screaming, danger, danger, stop the pain, get out now. It's just like going to the gym. You don't get a six-pack after 1 week, right? Or even 1 month. It's a total grind. And that point where you're super sore, you feel like you've made zero progress and you just want to quit? That is the exact moment right before the real results start to show up. And that's where most people give up. SIPs are exactly the same. And that leads us right into the second trap. We are addicted to excitement. Let's be honest, SIPs are kind of boring. That's the whole point. You're not getting that dopamine hit you got from picking a hot stock. And our brain takes that boredom and thinks, something must be wrong here. But here's the secret. In long-term investing, boring is good. Boring usually means your plan is working just fine. I love this quote because it just nails how ridiculous it is to quit when things look bad. Think about it. When the market falls, your same monthly SIP amount is actually buying more units of your fund. Everything is on sale. So stopping your SIP then, it's literally like sprinting out of a store the second they announce a huge sale. It makes zero sense, but our emotions just take over. Okay, so we've established the problem isn't the SIP, it's our own brain. So, what do we do about it? How do we actually fix this? Well, it all boils down to a pretty simple 5-step framework designed to help you beat these traps and, actually stick with it. All right, here we go. Number 1, Commit to a time frame, not a return target. Say, I'm in this for 10 years, period. Number 2, automate it and forget it. Seriously, stop checking your app every day. 3, expect the market to drop. It's gonna happen. It's normal. 4, if you're feeling brave, this is the time to actually increase your SIP. And finally, number 5, stop looking at the rupee value. Start measuring your progress in how many units you own. That's the real score. Now, all of these steps, they all point to one big idea. The most important thing for succeeding with SIPs isn't being a financial genius. It's not about complex charts or secret formulas. It's something much simpler, but also way harder to actually do. It's what I call the endurance mindset. And really, this is what it all boils down to. SIP success has almost nothing to do with your IQ. It's all about emotional endurance. It's about having the grit to stick with your plan when every single instinct in your body is screaming at you to run for the hills. You have to remember, the market is basically a machine that transfers money from the impatient to the patient. It will absolutely reward you for sticking around. But, and this is a big but, before it gives you that reward, it's going to test you. It's going to brutally test your patience, your discipline, and your emotions. So in the end, it all comes down to one simple question. It's not about picking the perfect fund. It's not about starting at the perfect time. The real challenge is this. Can you stay consistent? Can you keep putting that money in month after month, especially when it feels totally, completely pointless? Because believe me, that is the only time it really matters.